Good evening to all of you. Good evening. Can you hear me?
Yes.
Okay, great.
Yes.
Okay, so today, last segment, we are discussing on how to get the cost of capital. And I think we did a number of questions, okay, which were from the past paper. I think we did more than enough. We did substantial questions in relation to cost of capital. How many questions did we do on marginal cost of capital? How many questions did we do on the marginal cost of capital?
Two questions.
Or two questions? Okay. These are two questions, I think. Okay, I think we can do one. Let's see if we can get a. I'm not sure they can get another one. Let's see if they can get another one then. Okay, I suppose that you have gone through the question. Required. The amount of funds to be raised from each source during the year 2015 to maintain the firm capital structure. Number of shares to be raised. Okay, the level of financing which the MCC will change. The firms with a marginal capital, if they raise 20 million, the firm with marginal capital, okay, for 3 levels of financing. Okay, let's do it. So it was the company has a total of 100 million invested in net asset. The firm intends to increase the production during the year by 100 million. Okay, that's 100 million. So therefore, the amount the company requires, extra finance the company requires is 100 million. The company raises debt, okay, preferred stock, okay, equity capital within its capital structure. Okay, several alternatives are available. Okay, they can issue a debenture. They can issue additional 15% preference share. They can issue new shares at the current market price. The company can also use 10 million from retained earnings. Okay, fair enough. So we need to determine therefore what is the company, the composition of the company, the composition in the current capital structure. What is the composition? So here the company has two debts, debenture and long-term loans. Okay. So debt, the current capital structure, debt is equal to 30,000. That's 30 million. Okay, debt is 30 million. Preference shares. Okay, preference shares is equal to 15 million. Equity is equal to no, preference share is 30. Sorry, preference share is 30. Preference share is 30 million. Equity, that is retained earning plus the ordinary share capital, is equal to 40 million. Therefore, the composition, okay, and total here is 100 million. Therefore, the composition, okay, the percentage, these are sharings. Therefore, the percentage, this is 30%, okay, no need for working here, 30%, and this is 40%. Okay, the company wants to raise 100 million. Therefore, the amount that must come from debt is therefore that percent of 100 million. Okay, and the same applies to all the other. These are frameworks. What is happening here? Amount of funds to be raised from each source during. Okay, and let's do it. So the amount of debt will be 30%. So you can say debt, the total debt to be raised is 30. Okay, seeing that we are quiet and seeing therefore it's clear to you. Okay, that's therefore accounted for the amounts that again be raised from the debt capital. Okay, that is the 30 million from the 20 million from 9% debenture and 10 million from the 12% debenture. Now preference share. Okay, next is about preference share. Preference shares Okay, the company can issue additional 15% per share with a par value of 50 at 75 each. Okay, don't forget the amount required for per share is 30%. Okay, therefore, be that percent of the funds required, 30% of 100 million. So they're not dollars, sorry, the insurance. Okay, the insurance. Therefore, 100 million. If the funds to be raised from per share is equal to 30 million Kenyan shilling. Okay. Okay, equity, the amount that need to be raised from equity is 40% as per the capital structure. 40% for it to be equal to 40%, we multiply by 100 million. To give therefore 40 million will be raised from from equity. In the fourth bullet point, the amount that is going to be raised, company can generate 10 million from internal sources to finance this expansion. Therefore, the amount that is going to be out of retained earnings, okay, as per the fourth bullet point, therefore will be equal to 10 million. The amount that will be from issue shares will be the difference, of course. Okay, therefore will be equal to, okay, will be equal therefore 30 million, which is giving us the total 40 million equity minus the amount received from retained earning to give therefore 30 million. Clear? Question? Okay, seems it's clear. Therefore, and that's as per note 1. Note 2, the number of shares to be issued to raise the desired external equity. The amounts that need to be raised is 30 million. We can obtain that from Roman 1. Now we want to determine how many shares must be issued to raise this 30 million. Okay. Don't forget the capital. Okay, it's Roman 2. Capital is equal to the issue price. Okay, the issue price we multiply by the number of shares. We multiply by the number of shares that need to be issued. Okay, number of shares. Okay, capital is 30 million. So we need to determine therefore what's the issue price. Third bullet point, the company can issue new shares at the current market price of 88 and a flotation cost of 8 will be incurred. And that is it. Okay, therefore the amount to be received, okay, cash, cash received per share, cash received, okay, per share issued is equal to the share price, okay, the share price minus the flotation cost, Therefore, this is equal to 88 minus 8. Therefore, the amount to be received per share is equal to 80 shillings. Okay. Therefore, the number of shares to be issued. Okay. The number of shares that need to be issued. Therefore, will be equal to the capital required, which we obtained, to be equal to 30 million, divided by the amount received per share, which is equal to 80 shillings. Therefore, how many shares must be issued in order to raise the 30 million required?
That is 75,000.
25,000 shares need to be issued in order to raise the 30 million required. Okay, that's as man note 2. Note 3, the level of financing at which the money deposit capital changes. Okay, now if you observe that, what we call the breakpoints. Okay, if you observe that debt, we are going to be, let's say, we have debt. If you're going to raise 20 million worth of debt, the cost will be at 9%. If you raise more than that, the cost has increased. Okay, you can see there's a break here. Okay, I hope you get the point. That here we have a break. Okay, but in case you're going to be raising 20 million, okay, the cost will be at 9%. If you raise more than 20 million from debt, the cost increase to 12%. Okay, the same applies here. Equity. If you're going to use only 10 million worth of equity, okay, if you're going to use only 10 million worth of equity to finance this project, and the cost will be the cost of retained earning. If you're going to be raising more than that, okay, the extra will be from issue shares at an extra cost. Okay, you can see here there's a break, and the break is being contributed, okay, by the two, debt and equity. Okay, preference share is constant. Okay, preference share is constant; it doesn't change. Okay. As you can see, preference share doesn't change, okay? But where the break is occurring is out of equity, okay? As you can see here, we have retained earning, which of course has a cost lower than issue of new shares, as well as the debt. Okay, here 20 million will be at 9%. Any extra will be at 12%. Okay, so the break is out of the two, debt and equity. So let's determine therefore the break points. Okay, so this is working 3. Yes, working 3. Okay, break points. The breakpoint is given us, okay, the capital, okay, before the maximum capital, we call it the maximum capital, okay, maximum capital before the change, maximum capital, we call it just before the change, before any change. We divide by the weight of that debt capital. We divide by the weight of that capital, weight of the capital source. Okay, let's begin with the debt. We have said that in case you're going to raise more than 20 million from debt, they're also going to change. Therefore, the maximum capital you can raise before the change is 20 million. Therefore, it will be 20 million. Divide by the weight. The weight of debt is 0.3. Divide therefore by 0.3. Okay. Therefore, this therefore is going to give us how much? Don't forget the maximum capital you can raise before the change or in cost is 20 million. Anything above, the cost have already changed. Okay, we divide therefore by the weight of that capital source, which in this case, the debt is 30% or 0.3. We get how much?
Six.
That way.
Yes.
Okay, it gets 6,606,667. Therefore, the break. Okay, that in case you're going to be raising more capital above this much, that is 6,667. Okay, then you need to issue the 12% debenture. If you're going to be having the capital you'll be raising is below the 6,000, okay, then there's will be no change, of course, because the debt you'll be using is going to be at a maximum of 20 million. Okay. They have another break that is being introduced by equity. And you see that the break for equity is 10 million. In case you're going to be using more than 10 million from equity, okay, as you obtain here, then you need to issue new shares at an extra cost. Okay, therefore the maximum capital before the change in this context, therefore, is 10 million. Okay, therefore, it will be equal to 10 million. Okay, we divide by, okay, we divide by the weight of equity, which is 0.4. Give us how much? 25 million. Let me confirm, I don't know, just guessing.
Yes.
25 million, okay. And those therefore are the breaks. Okay, this is total capital, okay. Maybe just to show you this 25 million. If you get total capital, you can be raising it between 5 million. Equity is 10 million, okay. Don't forget here, we don't need to show this is just for a class here. Equity is 10 million because it's 40% of 25. Don't forget it's 10 million. Preference share, okay, we call it P, is 30% of 25 million to give us 10.5 million, I guess. And debt will be equal to 30% of 25 million to give us 7.5 million. Okay, don't forget here, the cost, the way equity is at cost of retained earning, okay, because all the entire 10 million is from one source, retained earning, okay. The same applies for preference share. Its cost is constant because, as you can see, there's no restriction, there's no limitation. The same applies in the case of debt, okay. Because don't forget, debt maximum is 20 million, and we are not yet at 20 million. Okay, so that's the first break. If you raise anything above that, for example, you raise 50. Okay, let's just give an example. If you raise 50 capital here, okay. If for instance you raise 50 million, 40% will come from equity. Okay, there's equity. Equity will be 40% of 50 to give us how much? 20 million. Yes, to give us 20 million. Preference share will be 30% times 50 million. Okay, to give us 15 million, I guess, 15 million. Okay, and the same applies to debt, which therefore the same will be 15 million, total of 50 million. What that means is as you can see, okay, now here we have gone above the 10 million, okay, don't forget, because here equity 10 million from retained earning and 10 million before new shares, okay, before new shares. And don't forget here the cost was low, but now since you raised more than 10 million, the cost has increased because you're issuing new shares, okay. Because therefore the break has been introduced because you raised more than the break of 25 million. You raised 50 million, okay. So the extra 10 million of equity will be raised through the issue of new share at an extra cost, of course, okay. Therefore, here the cost, here the company weighted average cost of capital, okay, will be different, okay, from this situation here, okay, will be different from this situation here. Why? Because now we have another equity source capital, source of equity capital at an extra cost, okay. Don't forget, preference share remained constant, okay, because there's no limitation on preference share. Debt is not yet at 20 million, okay, don't forget, because we say that the limitation, okay, as you saw here, is 20 million, okay. We are not yet at 20 million. Clear? So this is just to explain to you, not that you need to do this, okay? If you raise 667, okay, equity, okay, debt, preference share, we just call this preference share, and this is debt, okay, equity, you'll be having 40% of that, 6666, preference share will be 30%, okay. Debt should be equal to 30% also, okay, of the same. Okay, how much of equity are you going to be raising? $20. Yes.
26,666,000.
26 million.
And six.
You're breaking a bit.
26 million. 666,000. 667.
Okay, thank you. That's therefore the amount of equity capital the company will be requiring if they were to raise 667 and 67 shillings. Okay, as we have said, 10 million will come from retained earning. Okay, and the extra 16.66 million will come from issuing new shares at the same cost that we had here. Okay, the same way. Don't forget here we had 10 million and we had 10 million here. So the cost for equity doesn't change as per se. Okay, for comparing to the break of the previous break. Okay, because here we had 10 and here we had an extra 10 to be issued from the issue shares, and the same thing, 10 and in this case is 16 million are no extra cost. Okay, because we are only going to be issuing new cost. Okay, preference share is constant. Okay, now debt is where you have the issue now. Okay, what therefore is going to be debt? 30% of the 66667. 20 million. Okay, we get 20 million. Don't forget, you can see 30% of the debt is going to be raised from the 9% preference share. Oh, this is the 9%. Okay, the cost of debt is yet to increase. Okay, because 20 million, okay, is out of the 9% debenture. Now, in case you raise more, for instance, let's just pick, let's say 100 million. Okay, for example, let's pick 100 million. For equity, okay, it will be 40%. Okay, 40% of 100 million to give us 40 million, sorry. Okay, 10 million will be for retained earning. The difference, 30 million, before new shares. Okay, preference share, okay, will be 30% of 100 million to give therefore 30 million at no extra cost. Okay, the cost here is the same cost that we had here. So the cost is not increasing as per se. However, now debt is beyond the break point. Okay, now beyond the break point. Okay, therefore, debt should be 30 million, 30% of 100 million, 30 million. Okay, so you're going to be having the 9% preference share, which has a maximum of 20 million. Okay, and now the extra, which in this case the 10 million, will be from the 12% at an extra cost. Okay, that's because therefore the cost has increased. Okay, because you're issuing a new debenture now at 12%. Okay. Is that clear? Okay, so all this was just to explain to you so you understand what I mean by a breakpoint. Okay, now in case you have to draw this graph, Do we need a graph here? Level of financing. Okay, you don't need a break. You don't need a graph, but the graph can actually help you out. Okay, to understand what we mean by phase. Okay, let's draw a graph here. Anyway, let me just draw it either way. It will not be the best of the graph. So this is this is capital. They call it. This is capital. Capital. What falls in my y-axis here, in my x-axis? Okay, I'm not so sure. If the company wants to raise between 0 and so this is again because this is cost, this is capital. Yes, that makes sense. Okay, between 0 and the first break is coming when the first break is at 25 million. Yes, this is the first break, 25 million. Between 0 and 25 million, between 0 and 25 million, okay, the cost is constant. Okay, the cost is constant. For example, that level. Okay, between 0 and 25 million, the cost is constant. If you raise above 25 million, for instance, the way we did here, at 50 million, we saw the cost again increase because of the new shares to be issued. So the cost therefore increases. Okay, therefore we have the cost here between 25 million all the way to 6666667. Okay, the cost is increasing. Okay, for instance, to increases to that level. Okay. If you raise more than 6, for example, you raise 100 million, okay, like we did here, okay. Now the cost is going to increase because now you're issuing a new debenture. So the break now is you have another cost jacking up here. We have therefore another cost. Anything extra is going to be raised, okay, at a different cost altogether, okay. So this is what we call the marginal cost breakpoints, okay. So any funds you're going to be raising between 0 and 5 million, the cost is constant. Anything above that, the cost increases, okay. Okay, anything above 667, the cost even increases even further. Clear? So you don't need to go to draw the graph, but just to show you, okay, how the cost is behaving, okay, across different capital the company intends to raise. Clear?
Yes.
Question? Question? There's no question. Okay, great. Okay, so that's on getting that on part 2, the breakpoints. You need part 3, I think. Yes, the breakpoints. Okay. Now, you've been asked what is given the cost of capital if you have to raise only 20 million. Okay. Don't forget, 20 million is not yet below the break. Okay, as you can see here, it is. Okay, and here it is 25 million. It's not yet, it is 20. Okay, somewhere here. Okay. Don't forget, any capital raised between 0 and 25 million, the cost is constant. So the same cost would be if you had raised 10 million, the same cost would be in case you had raised 24 million, the same cost would be in case you raised 25 million. But any extra dollar above that, then of course now the cost increases. Okay. This is the cost therefore between 0 and 25 million. Okay, 20 million. Okay. Let's say at 20 million capital. Okay, at 20 million capital, the amounts that will come from debt is 30%. Okay, we don't need to do it. Okay, we know the proportion. Anyway, let's just do it. That will get that percent. That will be 30% times 20 million, which is 6 million. Preference share, okay, will be equal to 30% times 20 million, the same, to give us 6 million. Equity will be 30%, the 40%, sorry. Equity will be 40% times 20 million to give us therefore 8 million. As you can see, we are not yet above 10 million. Look at the limit for equity is 10 million. Okay, always remember the limit for equity is 10 million. Therefore, the company cost of capital, the weighted marginal cost of capital in that cost, therefore, weighted marginal cost of capital, therefore, will be equal to 30% of the finance came from debt 6 million at a cost of, what's the cost of this debt? Give me a second. Okay, so marginal cost of capital will be that percent. The cost of at 6 million, don't forget the limit for debt was 20 million, so we are not yet above the limit. Okay, therefore this gave me the 9% debenture. So what the cost of this 9% debenture? The company can issue 9% debenture at par. Okay, par value of 100 at an issue price of 90. That's the market value. Okay, that is it. Therefore, the cost of 9% debenture. So we can work in here. Cost of 9% debenture is equal to, therefore, the RD. We assume that this debenture is irredeemable because there's no any further information given to us. It will be equal to the interest 1 minus T divided by the market value. We express this as a percent. The interest, is there tax here? Yes, we have tax. Therefore, the net interest income, therefore, will be equal to, it is paying 9%. 9% times its nominal value of 100. Tax is that percent. Therefore, this gives, therefore, 6.3 shillings. Okay, therefore, cost of debt, therefore, will be equal to the interest, which is equal to 6.3 divided by the market value net of initial cost. And the issue price is 90. Okay, so it's been issued 90. Therefore, 90 divided by 90, and we express as a percent to give us 10%. Confirm.
%.
7%. Oh, okay, 7%.
Yes.
Thank you, 7%. Therefore, the cost of this debenture, therefore, is 7%. If we go back here and have a cost being 7%, plus the weight of preference share is to that percent, time the cost of preference share. The cost of preference share, we told that the company can issue 15% preference share at par value of 50 at a price of 25. Okay, therefore, cost of preference share is the next working. To be equal to the preferred dividend, okay, divided by the market price, okay, or the issue price net of any cost. The preferred dividend, okay, for this debenture, it is paying at 15%, multiplied by its nominal price, which is 50. This gives how much? 25, or rather 7.5. Confirm.
7.5.
7.5, great. They have the cost of preference share, therefore will be the dividend. 7.5 divided by the market value, which is 25. Okay, and we express this as a percent to give us 10%. Therefore, the cost of preference share the company has issued is therefore the cost of 10%. Therefore, that percent multiplied by 10% plus equity. Now, equity we saw is 8 million. So therefore, there's no, it is not yet at 10 million. Okay, but therefore, all the equity will be taken from, will be financed through the retained earning. Okay, therefore, you can say cost of equity. Okay, this is retained earnings. Okay, the part of retained earnings. Because don't forget, in this case, we're not issuing any new share. Okay, be equal to D equal to the D naught 1 plus G divided by P naught minus any cost of flotation. Okay, plus G. Therefore, D naught. So going to the first bullet point, this first, second, third, will be to the company. Second line. So the company can issue new shares at the current market price of 88. Cost of rotation. Now, since actually these are equity, this is retained earnings. Okay. Therefore, are you going to be carrying any cost of rotation? No. No, these are retained earnings. You're not going to go to the market and float them. You're not going to the market and issue. Therefore, actually, you don't have any cost of flotation. We don't have flotation cost here. Okay. So let me just get a lead of it so that it doesn't make any confusion. Therefore, be equal to. Therefore, the dividends, you mean to that the shareholders have been receiving dividends on an average, how much is the dividend? The company earnings per share this year is 10. The company pays 40. Therefore, the dividend the company has paid, therefore, is equal to 40% of the earnings, which is equal to 10. Okay, therefore, dividend equal to 4 shillings. The growth in dividend being told is 10%. Growth in dividend is equal to 10%. The P naught is equal to 88 shillings. Okay, we have all the variables for us to get the cost of the dividend. Therefore, be equal to the dividend is 4. Growth is 10%. We divide by P naught 88, and we add the growth in the dividend 10%. Give us how much?
%15.
Cost of equity through use of retained earning is 15%. We go back to our working. Equity is 40%, therefore 40%, okay, times 15%. There was the cost of capital, okay, for 20 million that you have raised here. Okay, this 20 million that you have raised, okay, as per Roman 4. What do you get? We just multiply. Yes. You get how much?
11.1.
11.1%. Okay, 11.1%. And therefore, the cost of this, if the company was to raise funds, okay, at 20 million. Roman 5, the firm cost of capital is the first, for the funds to be raised during the 2015 for the 3 level of financing. Okay, by 3 level of financing, what the examiners intend to assume was to say, between 0 and 25 million, okay, this level here, between 25 and 667, and between 67 and above. Okay, so these are 3 level of financing. So the first level we have done it, okay, because we did take 20 million, okay. So we just done that as per Roman 1, the cost, okay. Now between 25 and 667, okay, let me just take 50 because that's a bit easier to work with, okay, because 50 is between 25 million and 667, okay. So let's take that 50. What will be the cost, okay? At 50 million. 50 million worth of capital, okay, the cost of capital will be equal to, okay, so first is get to know how the money is going to be raised, okay, so from equity, it will be equal to 40% times 50 million, okay, and we get 20 million. Don't forget is that from equity, you're going to raise the money from, okay, retained earnings, okay, which the maximum available is 10 million, and the balance is going to be raised through the issue shares, okay, therefore, new share need to be issued in this case, therefore, worth 10 million. From debt, it is 30% at 50 million, okay, to give therefore 15 million, okay, we are not yet at 20 million, okay, the break, okay, then you have private share. This they don't have a limit, okay, private shares, don't forget, they don't have any restrictions, okay, they'll be equal to 30 million, 30% times 50 million, to give therefore 15 million. So don't forget, already have the cost of the private share, as we have done as per the previous example. We have the cost of debt, we have the cost of retained earning. So what we don't have is the cost of issuing new shares. So let's have that come therefore first working therefore. Okay, cost of equity. In this case, issue of new shares. Cost of equity. Okay, new shares, new share issue. Okay, this will be equal to cost of this will be equal to equity will be equal to D naught 1 plus G. Okay, P naught. Don't forget this time out you're issuing shares, therefore you'll be incurring cost of flotation. Okay, plus the growth. Okay, be equal to D naught was the dividend, which we got 4. Growth was 10%. P naught was 88. Flotation cost was the cost of flotation was 8. Okay, the growth is 10%. Therefore, what's the cost of issuing new shares?
%15.5%.
We get 15.5% with the cost of issuing new shares. Okay, as we had mentioned, the cost of issuing new shares is a bit greater, is a bit higher than the cost of issuing your own shares. Okay, and the cost of using your own internal finance. Okay, so if you have to compare the cost of issuing new shares, 15.5%, and the cost of using retained earning, which we got towards. We got here, you have it. Okay, 15%. Okay. Don't forget, issuing new shares is more expensive compared to the use of the company past earnings. Okay, compare the company use of retained earnings. Okay, great. They get 15.5%, therefore to be the cost of issuing new shares. And now you can get the company marginal cost of capital. Therefore, MCC at 50 million worth of capital to be equal to debt equity is 10 million. Okay, 10 million out of 50 was from retained earning at a cost of 15%. The balance 10 million, okay, which you have just obtained here, okay, is obtained from issue of new shares at 15.5%. Equity, now preference shares, now debt is 15 million, and the cost of debt we obtained was, what is the cost of debt? You have done that working already. 7%, okay, 7%. Therefore, times 7%. Preference share 15 million, and the cost of preference share is constant, okay, at how much is it? 10%, at 10%. Therefore, times 10%. We divide by the total capital here is, which in this case is 50 million. Therefore, divide therefore by 50 million, and we get the MCC, the marginal cost of capital, for 50 million worth of capital to be raised. And we get how much?
%11.2%.
And get 11.2% to be the cost of the MCC if the company was to raise 50 million. If you compare the cost, this is 11.2. Compare the cost as 20 million. Okay, at 20 million, the MCC was how much? 11.1%. Okay, 11.1%. As you can see, therefore, the cost has increased from 11.1% to 11.2%. Why? Because you have gone below the break. Okay, you have gone below the break. Don't forget here, you move from 20 million to 50 million. Okay, don't forget this is a different break altogether. Okay, it's a different break altogether. Now the next level, okay, don't forget it's between 667, okay, at this level and above. Okay, let me take the easier one at 100 million. Okay, therefore let's take therefore 100 million and we get what will be the cost at 100 million. The cost at 100 million would be equal to, okay, capital of 100 million. This is, I will just fix randomly, but between above 66 million, 666 and 666 shillings. Okay, capital of let's say 100 million. Okay, capital of 100 million. This 100 million is going to be raised as follow: equity. Okay, don't forget to remain at 40%. 40% of 100 million. Okay, to give it there for 40 million. This gain from issue from retained earnings. Don't forget to still remain at 10 million. 10 million. The balance will be from issue of new shares. Okay, issue of new shares. In this case, they are 30 million. Okay, preference share. Preference share will be 30% of the funds required. 30% of the funds required, 100 million. Give therefore 30 million. The preference share doesn't change. Okay, then you have debt with 30% times 100 million. Give therefore 30 million. Okay, the debt is raised through two ways. Okay, 9% preference share, 9% debenture. We say that this amount available is only 20 million, but we require 30. Therefore, the extra will be from the 12% debenture. In this case, the amount to be raised is 10 million. Now we have the cost of retained earning. We have done this already. Cost of new issue, cost of preference share, cost of the 9% debenture. So what we don't have is the cost of the 12% debenture. So that's therefore our next working. Okay, cost of 12% debenture. This is process. Okay, it will be equal to the interest. We divide market value of we divide P naught and we express it as a percent. Okay. The interest, the 12% debenture is the yes. Any extra debt finance will be raised through the issue of 12% debenture at 960. The par value of this debenture is 1,000. Therefore, the interest net of tax will be therefore equal to 12%. The nominal value is 1,000, but they have tax, which in this case is 30%. Therefore, 84 shillings to be the net interest be earned to infinity. Okay, therefore, the cost of the debenture is therefore 84. We divide by the issue price. Okay, this has been issued at 960, and we express as a percent. Therefore, the cost of the 12% debenture is how much?
8.75.
8.75. That way?
Yes.
Okay, great. Therefore, the cost of the 12% debenture is therefore 8.75. And now you can get the cost. We have got to obtain the cost from each of the 1, 2, 3, 4, 5. From those 5 in quote financials. Okay, let's get therefore my MCC. And 100 million would be equal to the retained earning. The amount to be retained to be received is 10 million. They have 10 million times the cost of retained earning. 10 million times 15%. The amount received from issue shares is 30 million. 30 million at a cost of 15.5%. Amount received from preference share, okay, is 30 million at a cost of 10%. 30 million at a cost of 10%. Amount received from debt is in two. One is 9% debenture. The amount received from the 9% debenture is 20 million. We have it here at a cost of the 9%. How much was it? I can't remember. The cost of 9% debenture. Where is this? Yes, 7%. Okay, therefore it's a 7%. So 20 million is raised at 7%, therefore times 7%. The balance, okay, which you have here, which was 10 million, was from the 12% debenture at a cost of 10 million at a cost of 8.75%. Okay, we divide the total amount to this, okay, which in this case is 100 million. Therefore, what's the, okay, you don't need to divide because already these are percentages, aren't they? Okay, and just divide because I've used millions here. Okay, so you need to divide, but in case you use percentages, okay, you don't need to divide. So I've used millions here. Okay, so we divide therefore by 100 million. Again, how much therefore to be the MCC? If you
$11.43.
get 11.43% to be the cost of to the MCC in case the company was to raise 100 million, okay, or anything above, okay. You can try at 70, okay. You can try at 80. The cost will be the same because it is above the break of 6,676,667 shillings, okay. So as you can see, the cost is increasing. It was from 11.1%, 11.2%, and now it's at 11.3% because they are going beyond the breaks. And also, you might have answered in that particular question. Okay, I think it's a good question because then I think it nudges your mind a bit when it comes to getting the MCC or the marginal cost of capital. Question? It was all clear? Okay, great. Therefore, that's I think it's those 3 questions are good enough for you to understand the concept of the marginal cost of capital. Okay, so if there's no question, then I go to what I wanted to introduce today on financial forecasting. Okay, if there's no question, then we start off with a new topic on financial forecasting. Now, financial forecasting, okay, it's a very small topic, not like it's a big topic, okay. At the end of the day, okay, company will have to, if for instance, company want to achieve, let's say, a given sales level, maybe in the next few years, okay, in the next, maybe the next 1 or 2 years, the company want to increase its sales, let's say from 10 million to 20 million, then definitely the company will have to invest more, okay, towards its assets, okay. So in this topic, what we want to determine is that if a company want to increase its sales level, okay, how much capital does it therefore need to inject, okay, to its assets, okay, towards the current as well as towards the non-current assets? How much capital does a company need to invest, okay, if they want to increase their sales, okay, to increase their outputs, okay, if they want to increase their profits, okay, from X to Y, okay? That's what we want to discuss in this topic, okay? I will call financial forecasting. The company to intend to achieve if they, for instance, want to achieve a given sales level, okay, achieve our given revenue levels, okay. That's what we want to discuss today, okay. Okay, this was quite straightforward, okay. So let me go to what matters. Now, when it comes to financial forecasting, you can use a number of methods. Okay, one of them is the use of the cash budgets, which you have discussed already. The use of cash budget, which you have discussed already. So I'm not going to go through it again. Okay, you can determine how much cash is needed in the next 3 months, the next 4 months. Okay, do the use of the cash budget. Okay, so I won't go through it. Then you have the use of obligation analysis. Okay, which, as you can see, you did discuss in MA. Okay, in the previous paper in MA. Okay, which I don't go through it. So the new method here is what we call the use of the percentage of sales method. Okay, this is what I want to discuss today. Okay, the use of the percentage of sales method. Okay, as a financial forecasting technique. Okay, now in this method, what we call the use of the percentage of sales method. Okay, what we want to determine, or rather, the process. I'm calling the process in quotes. Okay, we want to quantify. Okay, based on this amount of sale the company want to achieve, what is going to be the commensurate investment the company need to make towards its assets so that they can be able to achieve those high sales level they want to achieve. Okay, if currently you have your sales is 10 million, okay, you want to increase this to 15 million. Okay, if you currently have, you're operating at 100 capacity. Okay, if currently you are operating at 100% capacity, what does that mean? It means therefore you can increase your sales because already all your machines, all your assets are fully utilized. Okay, so in case therefore you intend to increase from 10 million to 15 million, then you must invest. Okay, the question here is that you must invest towards your assets. Okay, you must invest in your assets. Okay, now what does that mean? Okay, it means therefore if you want to increase 10 million, 15 million, then how much money do you need to invest towards your assets to be able to achieve this high, this new sales level of 15 million? Okay, that's what we want to discuss through the use of the percentage of sales method. Okay, and this process involves the following steps. They involve the following steps. Don't call them step in quotes. Okay, the first step is that first thing to do is that you identify, okay, the various items of the balance sheet, okay, that are going to be increasing in line with the increase in sale. Okay, don't get, for instance, if you want to increase your sales, okay, then most likely you need to make more. If you want to increase your sales level, then most likely, for instance, you must be selling to your customer on credit. Okay, so you must be offering your customer, for example, general term. Okay, so therefore we do expect that there'll be increase in the receivable. Okay, since you're making more sales, there'll be increase in cash. Okay, since you're making more sales, you need to invest more towards your inventory. Okay, so the first step is identify what assets, okay, as well as what elements, okay, of the balance sheet that will be increasing in line with the increase in sales. Okay, and of course, all assets will be increasing. Okay, all assets will be increasing. For instance, as I mentioned, if you want to produce more, then you need to buy more machine. For instance, okay, if currently all your machines are fully occupied, they are fully utilized. Okay, so therefore there will be an increase. Therefore, if sales are increasing, the net fixed assets will be increasing. The same applies the case of current assets. Okay, the receivable will be increasing. Okay, the inventory will be increasing. Okay, cash will be increasing. Okay, so as you increase the sales, then also the element of current assets will be increasing. So the first thing, identify those balance sheet items that are going to be increasing in line with the increase in sales. Okay, as well as the current liability also be increasing. Okay, for instance, from your suppliers. Okay, if currently you buy from your supplier, okay, let's say 1 million worth of goods on credit. Okay, so since now your sales are increasing, does that mean you have to buy from your suppliers more? Okay, maybe from 1 million to, let's say, 1.5 million. Okay, because these suppliers are the ones supplying you with the commodity. Okay, so since you want to increase your sale, then you must be buying more from your suppliers. Okay, therefore the trade receivable, the trade payables, therefore, will also be increasing. Okay, this applies to the accruals. Okay, as you increase your production capacity, also you require finances. Okay, from your short-term supplies of funds. Okay, if it's about the overdraft you used to get from the bank. Okay, now you'll be asking the bank to provide you with more loans since you are expanding. Okay, that is quite expected, that as you increase your production, okay, you can therefore be borrowing, for example, more loans from the bank. Okay. So the first step, as I mentioned, is to identify what elements in the balance sheet that we have at hand, okay, will be increasing in line with the increase in sales. Okay, that's what you need to get note of. Okay, what element within the balance sheet will be increasing in line with the increase in sale? And these are very simple. It's all the fixed assets, all the current assets, and definitely all the current liabilities. Okay. That's the first step. Identify the elements, okay, the various balance sheet items that will be increasing in line with the increase in sale. Okay. Clear? And definitely, maybe the last thing here is the retained. Okay, of course, since you have more sales, you have more profit, therefore, and of course, therefore, the company retained will be increasing. Okay, there's more sales, they have more profit, and of course, definitely more retained. Okay, assuming that you don't change your, you don't end up paying your shareholders more dividend. Okay, because you have more earnings. Okay, you maintain it. Okay, even after the company new sales levels are increasing. Okay. That's the first step, okay? Determining, okay, what elements of the balance sheet will be increasing in line with the increasing sales. Question? Robert, you have a question?
No.
Okay, great. Okay, that's the first step, okay? Determining, okay, what elements of the balance sheet will be increasing in line with the increase in sales, okay? All the fixed assets will be increasing, all the currency will be increasing, all the current liabilities will be increasing, as well as retained earnings, okay? So once we've done that, the next step, okay, once you have identified those elements of the balance sheet that are increasing in line with sale, is you express them as a percentage of sale, okay? Express them as a percent of sale, okay? What that means that if, for instance, we have a fixed asset here, okay, worth 12 million, okay, we determine the stock as percent of sale, stock as percent of sale is the value of the stock, 12 million, divided by the sales. In this example, if the sales was 40 million, we for 12 million divided 40 million, and we extract a percent. Okay, we get therefore 30%. If you have fixed assets, same way. Okay, well, how much do you have? 18 million. What's the assets? Okay, what do you have? What's the current sales? 40 million. Therefore, what's the percentage of fixed assets for sale? Okay, and therefore equal to 45%. So all the elements that we have identified above there, okay, in step one, you express them as a percentage of sale, okay? If you have receivable, do the same thing. If you have receivable, the same thing. Receivable, okay? Amount, for instance, will be, let's say, 15 million, okay? Out of 40 million times 100%. So all the elements that you have identified in step number one, okay? You express each of those accounts, okay? Fixed asset, current assets, current liability as a percentage of sales, okay? Because why do we need to do this? Okay, because we assume that even going forward, okay, the same ratio will be maintained. Okay, that even going forward, the company maintaining 30%. Okay, 45%. It does not matter what is the new sales level, but this ratio we assume it will be maintained even into the future. That's why we need, therefore, we need to determine these calculations. Okay, we need to determine, therefore, these percentages of sales. Okay. Okay, as I mentioned, step two is you express all the different levels of sales, or not sales, all the different accounts or the accounts you have identified in step number one as a percentage of sale. Okay, okay, which is very simple. It's the value of the account we divide by the sales volume. This is the sales level of that particular for that particular year. Clear? Any question? Okay, no question. Means that we are clear then. Now, step 3, okay, after you express all the different accounts as a percentage of sale, step 3, determine the increase in assets, okay. So in the above step that we just mentioned, okay, we have said that this is the ratio remain constant, okay, even going forward, even after the sales have increased. Then what does it mean? Since the sales is increasing, we have said that there'll be increase in the investment the company to make towards these accounts. Okay, for instance, in the case of stock, okay, we got the ratio to be 30%. Okay, and now the sales are increasing from 40 to 50, okay, to 60. Therefore, the increase in sale therefore is equal to 20 million. Therefore, as a company, since our sales have increased by 20 million, then we need to invest towards stock by 30%. Okay, there will be therefore 20 million times 30%. Give therefore we need to invest 6 million towards the stock. This implies the fixed assets. Okay, the ratio is for 5%. Okay, and the sales have increased by 20 million. Therefore, the required investment in the fixed asset therefore will be 45% times 9 million times 40 million to give us 9 million. In short, therefore, as a company, the amount of new investment required is 6 million for stock and 9 million for fixed assets. In total, 15 million. That for the company to be able to increase the sales from 40 to 60, they require 15 million worth of capital invested towards those current assets, both current and the non-current assets. Clear? Okay, and I'm presuming that silence means that you agree, okay, or it's clear to you. You have no question, okay. So in case you have a question, do not hesitate not to ask. Okay, so that's step number 3. Okay, we determine what therefore be the increase in the company total assets. Okay, don't forget an increase in assets means that the company need to look out for capital. For instance, the company need to look out for 15 million. They need to determine who is going to give us this 15 million to invest in our assets. Okay, the company to for financier who is going to be willing to give them this 15 million. Having now that's having determined therefore the total asset that you need to the total capital required to invest in your assets. Okay, the next step to determine therefore is who are going to be the financiers, who give us this money. Okay, who is going to give us this? Who is going to give us this 15 million? First is look from your own internal sources. Okay, first look at, for instance, look at for your retained earnings. Okay, before you go outside, check whether do you have money inside within internally. Okay, therefore use the money from retained earnings. So the first financial is going to be your own past earnings. Okay, and of course, what therefore will be the retained earning? With the profit you're going to making. Okay, minus any dividend you pay to your shareholders. Okay. So is the profit minus the dividend. That's what we define as retained earning. Okay, is the profit minus dividend. Okay, if you earn 10, let's say from the this 60 million you have just made. Okay, if 18 million is the profit and you pay 2 million to the shareholder, and therefore you have 16 million. Okay, in this case, therefore, you may not require capital because you may not require external financial. Why? Because you have 16 million from the retained earning and you only require 15 million. But if that's not the case, okay, assume that you have a case where you have here. The capital you have here is, let's say, 10 million. Okay, profit is 10 million. You pay 4 million as dividend, and therefore you have only 6 million. Okay, as your retained earning. Therefore, and you require 15 million. So you're not yet at 15 million. Therefore, you need an extra 9 million. Now, who is the next financier? Is going to be from the current liabilities. Okay, don't forget to say that the suppliers are financiers, even though they give you goods on credit. Therefore, what's the increase in the current liability? What's the increase in current financials? Okay, the short-term financials. Okay, the payables, overdraft, bank loans. Okay, how much money are they giving me? Therefore, determine the amount that they're going to be giving you. If, for instance, they give you, let's say 3 million. Okay, just an example. Okay, don't forget you needed 9 million. They give you 3 million, so you have a deficiency of 6 million. So if these two financials, the current liability, okay, and the retained earnings are not enough, okay, to finance your needs, okay, like in this case, you have an extra need of 6 million. What do? Now you can go externally, okay? Go to the external financials, go to the bank to take a bank loan, okay? Go to issue commercial papers in the market, okay? So you need to go look for another financial, not your current financial, not your own sole resources, but for another person outside the company who's going to be financing you for this 6 million deficiency that you have, okay? And that's kind of for the last step, I guess, okay? That in case there's any external finance required, then this is going to be obtained from external parties. It's going to be obtained from external parties. An example, the 6 million we have here, you need to go to the bank, for example, negotiate for a loan, okay? Go to the shareholder, ask them to finance you, for instance, okay? Go to issue commercial papers in the market, okay? So you need to also yourself to get this 6 million, this deficiency that you do require. Clear? Daniel, it's clear? Daniel?
Yeah, it's clear.
It's clear. Okay,
Yeah,
Lydia?
it's clear.
Okay, great. Lydia, is it clear?
Yes.
Okay, great. Okay, that's good in case it's clear the first time. Most of the time it's never clear the first time, but I'm quite happy that it is clear to you the first time. Now, let's do a question. We do a question that is asking us to get the external finance, okay? The same 4 steps we have just done, but now in a question, okay? We see how, therefore, would you determine, okay, the external finances required within a given time period, okay? So let me go through a question bank, okay? And so should you, okay? To look for a question that is asking us to do something like that. So I'm going through your question bank. We check whether they can get a question with such a requirement. If you get it, let me know. If you get one before I do. External finance. I have one here. November 2016. Let's share my. This is November 2016. Question 3A. Okay, go through it, then we discuss together. Okay, I suppose you've gone through the question, and maybe you've done you've done an attempt. So required the amount of external 12% long-term debt financing that will be required for the year ended that 1st December 2016. Focused financial statement and the weakness of the focus method you have used. First step, identify the elements within the balance sheet that varies in line with increase in sale. All the assets will be increasing, and of course, all the current liabilities. That's the first step. Step 2, get the percentage of sale for each one of them. So let's start with step 2, okay? The percentage of sale for each of the elements. For each of the items we have identified. So we can begin with the first one is the plant and machinery. Equal to, okay, 1.2 million. Okay, we divide by the sales. The sale for 2015 as per note 1 is 120 million. Therefore, divide by 120 million and we express as a percentage. Okay, that's for the plant machinery. Furniture, the same thing, will be equal to furniture investment 18.72 million, divided by sales 120 million, and we express as a percent. Okay, motor vehicle, same thing. Okay, it will be equal to 12.48 million, divided by 120 million, the sales. Okay, that's for motor vehicle. Inventory, okay, will be equal to 19.2 million, divided by 120 million, and we express as a percent. Okay, receivable will be equal to 14.4 million, divided by 120 million, we express as a percent. Okay, cash will be equal to 3.6 million, divided by 120 million, and we express as a percent. Payable, don't get these are current liabilities now. Payables will be equal to 18 million out of 120 million. We express this as a percent, and we have accruals, which will be equal to 12 million divided by 120 million, and we express as a percent. This therefore give us 10%. This give us 15%. Okay, I'll show both the others. So get for each of those accounts.
Plant and machinery 26%.
6%. Inventory
15.6. Plant and machinery. Plant and machinery.
Oh, we mix them up. Okay, thank you. Plant and machinery. Plant and machinery, is it? How much was it?
26%.
26%. Plant and machinery. Okay, furniture.
15.6.
Motor vehicle.
10.4.
10.4. Inventory.
16%.
Receivable.
12%.
Cash.
30%.
This is 3.6.
Oh, 3%.
So 3%. So 3%. Okay. And for payable 15%, and for the accruals 10%. Okay. So we get the percent of sale for each of those accounts that will be increasing in line with the increase in sales. Okay. Don't forget, we assume that this ratio is going to remain constant. Okay, we assume that this is going to remain constant even after. Okay, therefore, having done that, next step, okay, is to return increase in assets. Okay, therefore, the next step is to get the increase. Step 3 is increase in assets. But first, we need to get the increase in sales. Okay, before we get increase in assets, we need first to get increase in sales between the year. The sale for 2016, it will increase by 10%. Therefore, the increase is 10% times 120 million. Therefore, the sales increase will be equal to 12 million. Okay. Therefore, sales will be increasing by 12 million. Okay, between 2015 2016, as per note 2. Okay. Okay. For this company to achieve this increase in sale, then they must invest in the assets. Okay. Therefore, let's determine therefore the investment in assets. Okay. So assets increase will be equal to, we begin the first asset, the plant and machinery. Plant and machinery will be equal to the ratio, which is the percent of sale, which we got as 26%. Therefore, we go to 26% times the increase in sale, which is 12 million. Okay, furniture and fitting. Okay, which will be equal to the percent of sale, which will calculate to be equal to 15.6%, 15.6% times 12 million, the sales increase. Okay, next is motor vehicle. okay, which will be equal to the percentage of sale, which we got as 14.4 times 12 million. Okay, then you have inventory to be equal to, the inventory is equal to 16%, therefore 16% times the increases in assets, in sales, 12 million. Then you have receivable, which we got the ratio to be equal to receivables 12%, therefore 12% times 12 million equals 1.44 million. Okay, cash. The increase will be equal to, increase in cash is how much? The ratio was 3%, therefore 3% times 12 million. Okay, to give us 360,000, I suppose. Plants increase is how much, therefore?
$3.12.
Okay, 3.12, that is for machinery. Okay, furniture.
1.87.
Okay, no round enough.
It was 1.872.
Okay, for plants, have you not done any rounding off?
No.
Okay, don't round off for now. So it's 1,000,001.872.
Yes.
Okay, don't round off. Okay, motor vehicle, 1 million.
248.
248. Okay, inventory.
0.192.
Inventory, are you sure? 16% of times 12 million.
1.92.
92. Okay, 92. Okay, this is okay. Receivable is okay. Is it okay? I want to confirm. I don't know whether it's okay.
Yeah, it's okay.
Cash. Out of cash, 360.
It's okay.
Okay, great. Therefore, those will therefore be the increase in assets, okay, or from plant all the way to cash. Therefore, what's the total increase? So add all the total increase for all this from plant to cash. Sorry, how much?
9.96.
9.96 million, that's it.
Yes.
Okay, therefore get 9.96 million to be the increase in assets. Okay, the next thing is to determine how do we finance this asset increase of 9.96 million. Okay, we finance using traditional name. Okay, so financing. So step 4 is how we finance this, the financing of the asset increase financing. I'll call that way, asset increase financing. asset increase financing. Okay, so first, of course, the amount that we need is equal to 9.96. Okay, capital required. Let me just call this funds required. Let me call it capital. Funds required. We need 9.96. Okay, the financing will come from first retained earning. And be told that since there's an increase in sales by 10%, okay, from 120 to 102 million, therefore you can tell me therefore how much profit therefore is the company making out of this. The profit be told the profit ratio, was it the profit? Yes, not 5. The margin is constant, okay, each year. So we need to do our work in here for the margin. Can we just do here the net profit margin? Have we get the margin? No, as for note 3, the profit of tax for 2015 was 18 million. The sales then was 120 million, and then therefore the profit margin is how much? 15%. $15.
Yes.
Okay, 15%. Therefore, we have been told that we assume that the profit margin remained constant even into the year 2016. Therefore, in year 2016, the profit the company makes, therefore, is 15% times the sales, which in this case is 102 million. Okay, the company has a sale of 2 million in 2016, and 15% of it is profit. However, the company pays dividend. In note 4, the company pays 80, therefore they remain with 20. The amount that goes to 10 earning, therefore, is 20%, therefore times 20%. Is that clear? Okay. Therefore, what's the 10 earning, therefore, for 2016? You get how much?
3.96.
3 million.
960,000.
960,000. The way it is there. So 3,960,000, therefore the amount of finance the company will be received from the retained earnings. Okay, don't forget we need 9.96 million. Okay, so therefore the amount from retained earnings is not enough. Okay, therefore next we get to obtain the money from the current financials. Okay, we call the short-term financials. Okay, short-term finance. This is going to come from the payables first. Okay, the suppliers of goods on credit, payables first. And we've been told that the payables, how much money they're going to be giving us going forward. Okay, you've been told that the extra amount they'll be financing you, the ratio was how much? We got a ratio of 15%. 15%. Okay, therefore it will be the increase. Therefore, the amount they'll be giving you 50% times the increase sale, which was 12 million. So the amount of the increase in payable, therefore, is 50% times 12 million, which goes to finance your need for the 9.96 million. Therefore, how much payable, how much support, what extra will be the supplier giving you? 1.8. Confirm.
Yes.
Or from suppliers, they're going to be giving you an extra good worth 1.8. Okay, so you don't need to finance that. Okay, this is, let me just subtract here. Then you also have accruals, though the amount is not yet enough. So you have therefore the accruals, the accrued expenses. These are, don't forget, these are suppliers, so you're going to be paying them way little alone. Okay, after they've delivered service to you. Okay, therefore the accruals in this case, therefore the ratio was how much for the accrued expense? It was 10%. Okay, therefore the increase in the amount from the accrued expense suppliers will be 10% times the sales increase 12 million to give therefore 1.2 million. if these three financials, okay, the retained earnings, payables, and the accrual is not enough to take care of the 9.96 million, okay, we have to go externally, okay. In note 7, okay, in 7, now if the funds from these three financials, okay, retained earning, payables, and accruals, then you have to go through borrowing, okay. Therefore, the difference here goes to long-term finance, okay, long-term debt. Because this is long-term debt if the amount will be not enough. And therefore, what's the long-term debt we need? Don't forget the total amount we need is 9.96 million. 3.96 million comes from retained earning, 1.8 from accruals, from payables, and 1.2 from the accruals. If the three are not enough, then any extra will be from long-term debt. And how much is it?
3 million.
3 million. 3 million. Okay, this will become therefore the amount of long-term debt the company needs to go and borrow, okay, to finance therefore the increase in assets. Okay. Question? Okay, no question. Great. Therefore, having done that, the next step for us is to we've done party, Roman 1, okay, to get the amount of external finance required. Okay, we've done Roman 1. Roman 2. We mean as if this was to happen, okay, what would be the company balance sheet as of 2016, okay, 1 year later, okay. Therefore, the balance sheet will be as follows: plant and machinery, okay, plant and machinery value will be equal to as of 2015, the amount was at 1.2 million. However, this is increasing the long-term asset. We have done an investment which was equal to 3.12, therefore plus 3.12 million. Okay, we have furniture. As of 2015, the value of furniture was 18.72 million. Then there was the company did make an extra investment as of 2016, which is equal to 1.872 to 1.872 million. Motor vehicle, the same thing, will be equal to 12,480. Then the company did invest 1,248,000. Okay, we have inventory, which will be equal to inventory, which is 19.2 million, plus the increase 1.92 million. Okay, receivable, which was 14.4. The increase was 1.44 million. Then you have cash, which as 2015 was 3.6. It is increasing by 360,000. Okay, you have 3.96 million. Then you have payable. You have payable, okay, and the payables will be equal to 18 million. It will increase by 1.8 million to give therefore 19.8. Then you have accruals, okay, which was equal to 12 million, an increase of 1.2 million, an increase of 1.2 million. Give therefore 13.2 million. Okay, so get the figure for each one of them. What do you get? Plant audit for accruals. Plant closing balance, is it okay? Okay, so you have calculators with you.
Okay.
Is it correct?
Yeah. Furniture is 20.592.
592. Motor vehicle, is it correct?
Yeah, it's right.
Inventory, is it correct?
21.12.
Yes, okay. Receivable, is it correct?
15.84.
Cash,
Cash is 3.96.
payable,
19.8.
accruals.
13.2.
Okay, good. Accruals, therefore, 13.2. Dog, you also have retained earnings. You also have retained earnings. Okay. Which as per 2015, the total retained earning value was 17.6. Then also in 2016, there was some money that went to retained earning, which was how much? 960. Okay, plus therefore that 960 give us how much? 21.56. Confirm.
Correct.
Okay, great. Since you have all those closing balances, I guess we can prepare the balance sheet as a 2016. Okay, therefore we can call it this. This is Georgina Limited. This is Georgina. Okay, pro forma balance sheet. Okay, as at, and this date is 31st December, 2016. Okay, so we can begin with assets here. We have plant and machinery. We just prepare as the examiner has given us there. Plant and machinery. The closing balance we have obtained is equal to that's 2. Okay, so we have them in thousands. So that 320. Okay, motor vehicle, furniture. Next is furniture and fittings. Okay, which we got a closing balance value 2592. 2592. Okay, motor vehicle. Closing balance we have obtained it to be equal to 13,728. Okay, we have inventory. Closing balance we obtained it to be equal to 2112. Yes, okay, receivable. Okay, we got closing balance value of 1584, 15,840. Okay, we have cash. Okay, which we got a closing balance value of 3,960. They'll give the total assets. Okay, at the close of 2016. Okay, then we have financed by. I'm just want to replicate what the examiner has given us. Okay, financed by ordinary share capital, which did not increase. It was remain at 42,000. Okay, retained earning. Okay, which we got closing balance value. Retained earning we have here 21,560. 21,560. Okay, then we have, what else we have? The debenture, we have 14% debenture, which did not increase. It is at 10 million. Then don't forget you have now the long-term debt, the one you just issued. You have just borrowed the 3 million. Okay, I'll just remind you where we got it. Where was this? 3 million. This long-term debt, 3 million. Okay. Okay, 3 million. Then we have payables. The closing balance value of how much? Payables, the closing balance 19.8. Okay, accrued expense. Closing balance, we got 13.2. Okay, total assets, what do you get?
No, 9,
I lost you.
109,560.
9,560. That's total assets of the company. Okay. Equity plus the liabilities is how much?
$109,560.
9,560. Okay. Now, in case in case the balance sheet doesn't balance, then of course you have to go back and try to check where your mistake was. Okay, so you have to go back and work it out again. Okay, okay, good that it has balance. Okay, any question? Faith, Nyongesa, any question? Faith, Nyongesa, any question? Hey, Faith is not in class. Faith Mary, any question?
Some okay.
Yeah, okay, okay, good. Okay, that's all. Therefore, you prepare therefore the financial requirement in the company what to intend to increase its sales volume. So you've been asked about the weakness of the method. So let me see if I have those notes with me. Okay, weakness of the method. That's the case you want to put down. The assumptions are actually the weakness of the method. Okay, so I would propose that you if you want to note down the assumptions, those are the weakness actually. Okay, or you just need to critique them. Okay, so note down the assumptions if you want to. So take 2 minutes to note down those assumptions. Okay, now these assumptions that I mentioned, generally, don't forget, they are the limitation of the model. Okay, for example, you have to go through each one of them. The fundamental assumption is the use of percent sale is there's no inflation in the economy. There is no economy with no inflation. So that is essentially may not be the correct thing. That's therefore one of the key weakness of the assumption. The farm operates 100% capacity. Not all the farm operate the full capacity. Okay, there will be most likely a spare capacity. Okay, in case there's spare capacity, then you can't use this method. Okay. The farm not issue any new capital. There is no restriction when it comes to farm issue new capital. It can issue. Okay, therefore, if it issues new shares, then generally, therefore, the model therefore cannot be applied. Okay, the assumption of the percent of sales to remain constant during the time of forecast is not necessarily going to be correct. Okay, they change. Like for instance, we got 40% to be the ratio. We got 26% to be. What has happened here? Okay, we got 26% for instance to be that is 26% to be the percent of sales for the PP, the plant and machinery you just done now. Okay, we assume it's going to remain constant for the next 1 year. There's no guarantee this is going to remain constant. Okay, Then the net profit margin, we assumed it again remain constant. There is no guarantee that it's also going to remain constant. Okay, therefore the assumptions of this method are therefore the limitation or the weakness of the model. In this question, you're meant to do discuss to comment on 2 of them. But either way, you can have those 5 assumptions to be the 5 limitations of the model of the method. That is. Question. Okay, if there's no question, then I will propose that on your own, during your own free time, okay, there's some few questions that you may want to make an attempt on, okay. Let me just try to check them out, okay, just so that you can cement this idea on how to use the percentage of sale method, okay, which actually is a very easy method, okay. It's a very easy question, by the way. Okay, so let me just check you can take note of this question because I'm not sure they're going to have time to go through them, but for your own revision, okay, this is one of the questions in here. This is where this September 2015. Okay, question 5A, question 5A. Okay, there's a question that you may want to attempt to do. Okay, we look for another question which you can try out. Okay, I'm still trying to look for one. Here it is. We have November 2011, which I'll share on our WhatsApp platform, question 4A. So this one I'll share, I'll screenshot it and then give it to you on WhatsApp platform. I think this is the question that I can see here. Yeah, those are the questions that I can see here. I guess in case you, those I think more than enough what you require. Yeah, there's another one here. Okay, this is from June 2010. June 2010, question 2B. So these 2 questions, I'll share them on WhatsApp platform. Try them out, okay? For your own sake, not that I'll ask you to say this to me, but try them out. If the balance sheet doesn't balance, then you can go back and check the mistake that you may have made. Okay. Maybe in case you have time during the revision time, we will go through those 3 questions. Question. Okay. If there's no question, then fair enough. We can call it a day. We meet on Monday.